Okay, well, let's look at some more examples. Now here you can see Merrill Lynch. You can see here the price has made a higher high. There we go. But if you look at the corresponding point all the way down here on the MACD, it's made a lower high. It's failed to make a higher high, and therefore that's bearish. So when the MACD starts moving below its signal line, that's a particularly good signal to sell, and you can see how the price has correspondingly fallen quite sharply. Okay, well I told you about bearish divergences. Well, what about bullish divergences or positive divergences? Well, they occur at the exact opposite end. They occur when the MACD makes a higher low. As you can see here, one low and a higher low and an even higher low there, but the price fails to confirm that. As you can see here, the price has made a low, then a lower low, even though the MACD made a higher low, and then a subsequently lower low, and the price made a higher low. Look at that for a second. Lower lows, higher lows. That's a positive or bullish divergence. It suggests when the MACD is going to start moving higher, and especially when it breaks its signal line, that's a bullish indicator for the stock. It has a high probability of moving higher. That's what we're looking at, probabilities. Here's another example. Higher low, lower low. As it happens, and the MACD starts moving higher, you see this huge, very powerful rally there that we want to get into. Now, why are we looking at these? Well, we're looking at the reasons I mentioned previously, which is we want to find positions which have a high probability of the stock price moving up. That's the whole reason why we look at them. Okay, let's move on a second. What do we see here? Now, this is another indicator. It's the stochastic. What you can see here is a share price. It happens to be drawn not in Western candlesticks, which is what we've been looking at up till now, but Japanese candlesticks. Don't worry about that for the moment. What's important is this little thing here, which are the stochastics. And these signals, they have similar rules of interpretation to the MACD. It's the fast and slow stochastic. Well, I have to tell you, I tend to look at both together, and that's fine. And I tend to add the MACD as well. Why? Because I want corroborating evidence. I don't just want to follow the MACD, I want to follow all signals. Now, what are these telling me, and what are the rules of interpretation here? Well, similar rules. Overbought, starting to move lower. Overbought, starting to move lower. Oversold, starting to move higher. And again, these can have negative divergences and positive divergences. You can see that when this starts to move higher, as we said with the MACD, there's some degree of bullishness. Now, the problem is with the MACD as an indicator, it tends to be a little bit slow. By the time it moves through its signal line, the stock tends to have moved a fair bit. The problem with the stochastics is that they can be a bit too quick. They can give a lot of false signals. That's why I like to look at all the signals together. And only when everything seems to be right, all the indicators suggest getting in, would I get in. If only one of them's giving me a signal and the other one really isn't, then I'm not interested. And the point there is we need corroborating evidence with these things. Let's have a look at this principle of extreme momentum again. Remember I said overbought when the MACD is at a relative high and the price is corresponding to that, and then we see the MACD moving lower. Well, you can see here how it started to move lower. You can also see how the MACD might not always give that extreme connection. Now here it's not at a relative extreme, it's at the zero level. Look, the number 0 here, which is why when it falls it doesn't really give such a big fall as it does here at this point. Let's have a look at something else. You can see here it's gone up. It just goes to show it's only right 7 times out of 10. Not much of a decrease before it starts resuming again. And it's only at this point, even then it's falling. Price hasn't really moved until it gets to about there. The point here is when I see the MACD like this, I certainly don't want to go long. That's for sure. Similarly, when I see the MACD around here, I'm probably not thinking about doing anything other than buying, if at all buying. And similarly, if I see the MACD here, I'm not looking at going short. Why is that important? Well, look at this when the price was down here. If you looked at just the price and not the MACD, how would you know what to do, whether to buy or sell? You wouldn't unless you looked at this as well, and that would tell you that you certainly don't want to be selling around here when the MACD's around there. You probably want to be buying. And that's the whole point with the indicators. They tell us things that we don't actually otherwise see. It's not just a buy or sell signal, it's also a not buy and a not sell signal. And that's incredibly important because, as I've said before, trading is not just about the money you make, it's about the money you do not lose as well. Well, let's look at another example, positive divergence. Price pretty sideways. This is the relative strength index. See how it's rising? Slight bullish signal. I wouldn't just trade off the back of that. I'd want to see all the other indicators at the same time as well. Here, a positive divergence. I've drawn it from peak to peak. You can draw it from bottom to bottom, which is down here, lower lows, but the MACD makes a higher high. There, that's a positive divergence. When it moves through here, it suggests going long, and what happens? We get in at, say, 340, probably out taking at least a 20 pence rise. Exits we'll have to deal with later. Now, let's look at another one. What we've got here, positive divergence. Notice how the price is moving lower. We get a breakthrough resistance here. That's how we know that's our entry point, our stop loss somewhere just beneath that point. And bang, we're into a huge rally. Let's look at that again. Higher high, lower low. We want to, as this starts moving higher, set some kind of entry point. Well, we set it at a point where we know where if the price goes there, we must be right, and we put a stop loss where if the price goes there, we know it's probably wrong. And what happens? It starts rising, we get in, we make a fair bit of money off the back of that trade. Want to have a look at some more? Okay, positive divergence. What happens? It's going sideways, gives us some kind of bullish indication, price moves higher. Ignore this for the moment. I don't really like looking at patterns within the stochastics. This is a stochastic, by the way. Negative divergence. Well, price makes higher highs. Look at that. Lower high. Bang. Falls through. We want to start looking at exiting. What it's telling us is we probably don't want to be looking at going long. That's for sure. Similar situation here. Higher high on the price. Lower high on the momentum. Bang. Price starts moving lower, and similar point here. Lower high, price pretty much gone sideways, bang, we're out of there. And another one, MACD going lower highs, price higher highs. After this huge long uptrend, we still want to be thinking of getting out. What happens? We're one of the clever people who get out along here instead of many who probably would have got out along here. That's the reason why we do it. And here's another. Lower high. Look at the price going sideways. We decide we want to get out pretty sharpish before the price falls. What happens? That's a fast forward on that. Look, still the same company. Bang, starts moving lower and lower. Saved us a fair bit of money, didn't it? Do you want to have a look at another? Negative divergence. Here, look at that. Higher high. What's happening? We decide we want to get out. Probably get out when the price breaks the uptrend line. Remember, we always look for price confirmation somewhere around here. And lo and behold, we put a stop loss maybe on this side of the uptrend line where the price shouldn't go if we're right that it's going to fall. Put a stop loss there, go short here, and we're out. Okay. Similar principle with a bearish. Or over here, we've got, now that's the crossover. Price has made moving average. It's crossed its own moving average, breaks through, we set some kind of level, and we're out. Yeah? Okay. Now, that was just some of the indicators. There's a lot of other indicators we've got to look at, and that's what we're going to look at in the next chapter.